All right, so after finishing the quarter on a high note, the market has been kind of stagnant since the end of last week on the June 30th. And so the market, around July 4th, it's, holiday week, a half day trading on Monday. So this is understandable. Now next week back to a regular week, and we have CPI coming up. We have the Fed coming out at the end of the month. There's a ramped up expectations of a rate hike. Rate hike. The question is if they're going to do a second one after this one here in July, which is widely expected. That's going to start to really put some pressure, especially with yields up where they're at on equities. Again, also considering the technical picture. So I'm going to break down that picture in terms of the strength of this bullish move that it's been on, and the beginnings of what may be a convergence period that can transition to a consolidation period in the S&P 500. So I'm going to break that down, taking a look at the major moves in the market, some good broad bullishness in U.S. sectors. There are some weakness and some risk appetite. There's some convergence signs and some risk on relationships. We'll talk about that. And of course, our trade idea is a stock that's been on a sideways pattern for most of this past year. We've been taking advantage of that, and we'll do it again tonight, and we'll talk about how. So let's go ahead and get started. Today is Friday, July the 7th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video here where I do the trade ideas before the market closes. So you don't have to wait until the next morning. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing with this thumbs up icon. Click that like button there. Again, that's how we get our content out to all of our followers. Again, our goal is always to get 100 likes on Twitter, considering the views that it gets. We got that's a higher number than last time, but we're still kind of falling short. So again, those who like it day in and day out, thank you very much. Please continue to do that. Those who don't, you can do right now while you're watching with one or two really easy clicks. Let's start off like we always do, looking at the S&P 500 with the market forecast indicators. You can see the decline we had pretty much at the end of the day today. It brought the momentum line back down, though it stayed in bearish territory. The near-term line got into bearish territory, so that pretty much ends this near-term rally. It's slightly higher high, so we continue with the trend of higher highs. See, this was one big near-term rally, obviously not nearly as long. You also had, this was one near-term rally over here. So we've been progressively getting higher highs and higher lows, but this low is a lot more attainable than the last near-term low point. So while the odds of getting a lower near-term low were very low coming down here, the odds of getting a lower near-term low are a lot higher on this one. So that's something to keep an eye on in terms of, obviously we're still above 1.5% above 30-day moving average. So nothing is imminent in the least bit. But like I said, it was only a slightly higher high, which means a lower low is easily attainable. Now, the last few times we got, kind of equal lows here. When we got slightly higher highs, that wasn't very long. We got an equal low point, and then we had this period, and then we kind of got, a 50% retracement, and then we rallied. So we'll see if we end up getting an equal or low or not. But you can tell here, if I bring on the Fibonacci lines, you can see that if we do break the 30-day moving average by any degree, then we're flirting with the 23% retracement of this intermediate rally. And that starts the pullback, right? Remember, this is all noise here. We're still trending, we're still impulsing to the upside. So we don't start the pullback of the intermediate move until you break that 23% retracement, which also happens to be back below the 62% retracement of the correction, and also happens to be the August peak, right? So that would be a pretty significant break if we start. Of course, there'll be very significant support at the 4,200, the 23% retracement of the post-COVID rally, the 38% retracement of this intermediate move, the 50% retracement here, pretty much at the February peak. You know, the 50% retracement of the correction move that we've been above for a long time now. So there'll be loads of support at 4,200 plus or minus however many 25, 50 points or so, because like I said, your 50% goes a little bit down to about 4,150. Needless to say, you know, that's when things would start to get. So, you know, a few days in a row drop like we've seen, you know, we saw for the last few weeks, that doesn't necessarily put us on edge, right? If you can even see from the whole moving average, when we had turned bullish with that quarter end rally, that big spike to the upside, big candle to the upside, that obviously failed to extend a new run to the upside because we're down, and you can see we've been bearish, and the PPO is back below its moving average. So we are, you know, again, this did not start a new near-term rally, lengthy near-term rally to the upside. 7 to 12 days is your typical run when you're on a bullish trend. So kind of shorter. We did get in the reversal zone, so that's good. But now let's see how long. We should bounce immediately out of this. If we're going to maintain this bullish trend, the near-term line should bounce right out of bullish territory. You can see how it doesn't stay very long, and this was the longest. But if it dips down on Monday down into the oversold zone again, and we flirt with a lower low point, which means we're flirting with getting below the 30-day moving average, which means we're flirting with, because if we get below the 30-day moving average, depending upon how fast it takes, because your intermediate line is still 90th percentile, but remember, bull tags, all these intermediate declines start with bull tags. So as soon as we break that, then, you know, we could be at the beginning stages of an intermediate decline. It doesn't mean necessarily that, you know, the world's going to be over, right? The intermediate decline, the likelihood of the intermediate decline of only coming to the 38% retracement is very high. Again, considering the February peak, all the Fibonacci levels, all in the same zone, as well as in that same area is the point of control, right? So you got your point of control in this area too. So loads of support down here for the markets. It would be very difficult for it to break significantly through this area. Like I said, 4,200 plus or minus however many points. All right, let's go back to the market forecast and take a look at like the Russell 2000. So the Russell 2000 was up today. Remember, it had been more bearish than the other indexes. It was up today. Did not fall as far at the end of the day. Held up very well and did not get the bull tag yesterday. Again, the intermediate line is actually still above 80. But we are susceptible to a bull tag very soon, right? Again, a bull tag, which starts these intermediate declines, or it can be good bounces. But you can see lately, the last three have all started declines. Even with the bounce there, it started declines, these intermediate declines. So bull tags, right? You either bounce right off of them and continue the intermediate run for however long, because that's what happened with the SPX, right? You got a bull tag here and you maintain the intermediate run with a good long rally, right? So it's either really bullish when you're already bullish, or like I said before that, the 5 previous times before that all started. So 1, 2, 3, 4, when you count all these together, 5 all started each of the 5 previous intermediate declines. This was the first 2 that were continuation patterns and not reversal patterns. All right, when you look at the NASDAQ, which was a little bit more bearish here, you can see, remember, it's been so bullish. It's been on this intermediate run. It also had a bull tag as a continuation pattern, the first one that we've seen. Its market sentiment line is well above 80, one of the highest levels, again, that we've seen since going all the way back over here. But again, a divergence developing, and we're really converging towards the moving average here. So we're setting ourselves up for another bull tag to occur potentially as soon as next week, as the near-term line is also down into bearish territory here. Let's take a look at the weekly chart. You can see on the S&P 500, again, we finished the week with the size of the candle, size of the body of the Heikin-Ashi candle, still below its moving average on the weekly chart. We did get a slightly lower high with a higher low, So we are again due potentially for a transition candle next week, right? If you don't get the transition candle, then the combination of a lower high and a higher low is kind of a precursor to that. We had that here and we did not get the transition candle, and now here we are again, kind of back-to-back instances of a lower high point, 44.58 down to 44.56, but a higher close, Hakinyashi close. And so now, again, transition candles, you can see we've had a couple of them here that preceded these bearish moves, the week of 12.5 and the week of 2.13. When you see, so here's 2.13, not so bearish, but 12.5 was. That's the kind of transition candle that would be a bearish move, right? And if we got something like that here, and it would be a transition candle and a red arrow no less on this moving average, then we're looking at more of a decline. So let's see what ultimately we get next week. Though again, if we get a higher high point, that throws all that out the window, and we're still on the nice good bullish trend here. Again, looking at some of the other indexes like the NASDAQ. Here we go, NASDAQ. It did get a higher high and a higher close, so we don't have that issue there. The Dow Jones Industrial Average did not get a higher high, and it's also multiple transition candles now. So we've got that transition candle there. It was not that bearish of a candle, actually it kind of was, but you can see we haven't really reversed yet. But we also haven't closed back above this body, the one that started the reversal. So that's what throws it all out the window and reboots. And we never did that. And over here, we had 5 weeks of transition without ever closing above that before we finally reversed. Here we're at 3, and we have a red arrow. So let's keep a really close eye on how the Dow Jones reverses next week. The Russell 2000 just got a golden cross on the 10 and 40 week exponential moving averages. But again, similar story. We got a transition. We've had 3 weeks of transitions now, and we have not closed back above that body to take away that pattern. And again, we're set up for a potential reversal, an actual transition that would actually be more of a bearish candle here than what we saw even this week. So keep a close eye, because we did get one 2 weeks ago. Keep a close eye on how things might be, again, as early as next week, a full week of trading here next week. Looking at the 3 green arrows also kind of gives us an indication, because you notice we didn't stay green for very long. When you're bullish, you like to get the non-shaded areas to be really short, and then when you get back to green, you want them to stay green for a while. Get 3 green arrows and stay green for a while. Obviously, that wasn't the case. We had a pretty lengthy non-shaded area. We're still non-shaded on the Qs, and our 3 greens didn't last very long. And in fact, on the Dow, we're already to 3 reds. The Dow Jones Industrial Average not quite getting a bull tag on. Well, I actually did get a bull tag on the index. So there's the bull tag, right? Are we going to bounce right off of that, or like the last one? Can again our cluster here, 2, 3, 4 bull tags all started the intermediate declines to the downside. But you can see we do have 3 red arrows just like that on the Dow. And then of course your Russell, same thing. Your lengthy shaded, non-shaded period with a very short screen shaded. So again, we're seeing weakness that would suggest that we're headed towards that reversal, a reversal there. Now let's take a look at the actual 2-line versions. And you can see the convergence here. Again, we are below the 8-day moving average after having been bullish for so long. We're not below the 17 yet. The MACD is below its moving average. So we are in convergence mode. Like, we're not consolidating until we break the 17, which is the second number in the MACD that we're using. But we are in convergence. The MACD is below its moving average. We're still above. So we're, it's kind of a divergent pattern too. A slightly higher high with obviously lower highs. Again, that sets us up for that move to the downside. Again, the diamonds not only is below its 17-day yesterday, broke below the 8 and 17 yesterday, is broken below the 30 today. The 50 is right there, as well as the point of control is right here. And it is extremely top heavy. And this volume that's pretty much from here to here is going to get lighter and lighter. So it's going to be even more top heavy, which is going to make any kind of decline on the Dow more precipitous than it would be on, say, the Qs, which have a lot of volume support, though getting down to this level would be pretty precipitous decline because, again, we extended so much during this parabolic move. We haven't left a whole lot of room behind us to fill in with support. If we look at some of these other oscillators, remember this is also in a divergent mode. We are below the ADX, the positive indicator is. Remember the diamonds is more bearish, that we've already had the ADX never did get very high, and we're already crossed over. The negative indicator is above 25, and the positive is working its way back down, potentially to being below 25. IWM obviously had a pretty decent bullish move too, but it's potentially waning as this ADX is moving back down below 20 there. So you can see the signs of weakness showing up from the Ichimoku cloud. We're still above. We are on a mature trend. We're still above the Tenkan line, the green line. So we still have some pretty good. We're still okay. You break through that line like we have. Again, the diamonds never did get a mature trend. In fact, we never really even got a intermediate strength trend going because we didn't quite get above 2. We didn't quite get above 65. And for that matter, we didn't quite get very high above the green line. And now we're flirting with getting back below the blue. And again, you can see how quickly and easily it would be to get below the cloud. So the diamonds is in a lot worse shape than, say, like the Qs, which are well above the cloud, which have some room. There's some support down here that it can use. And of course, it's still above its green line in a very, very mature trend. Breaking its green line would be a sign of weakness, and especially considering how close the blue line is to that green line. All right, if you look at the RSI and the CCI, the S&P, you can see we're still in bullish levels. We're still in the upper halves of these charts for the S&P 500. The Dow Jones, we're not. So we're in the lower half again. But this time, this lower half move on the CCI is accompanied by a move into the lower half on the RSI. So, again, that's not too bearish. You have to get below 40. You have to get below at least minus 150 here, but stay below that minus 100. And so we're not quite there yet, but you can kind of see the signs are starting to change. Of course, here you're below the moving average on the S&P, so that's a sign of convergence as well. You look at the breadth indicators, and you see how we have flip-flop. We're kind of flip-flopping between positive and negative, but we're definitely having a hard time getting above 500, which you really need to see if we're going to trend. I mean, not getting above 500 is one of the bigger fake-out characteristics we're seeing right now, as well as the money flow, which continues to be really weak, relatively speaking. All right, again, you look at that August, even this peak here, this peak in volume that we had from September, we're still not even close to it. But the August one in particular, which we are above the price right now, but still nowhere near the volume, and your money flow index is now dropped below 50. Not below 40 yet, so we're not too bearish, but we are definitely in convergence mode there as well. And then finally looking at the Bollinger Bands and the Keltner channels, after having gotten above that band and the Keltner channel on the last day of the quarter, we are back out of the upper quartile, back into the middle half of the bandwidth with falling momentum, and it's really, really soon red dots, which can signify a change in momentum. When you get the red dots there from one side to the other, you can see how the change in momentum pretty much occurs through the red dots. More often than not. Sometimes it can occur with the band still outside the channel, but more often than not it occurs through the red dots there, and it appears we are a day away from getting red dots again as the bands appear to be moving inside. The bandwidth is almost back down to its 150-day low. Its 150-day high has really come down to a low level here, so the bandwidth is really kind of tightening up. It's kind of a theme here on the 4-week range too, as we are really tightening up the range after filling in most of the gap from yesterday. Yesterday had a lot of opportunity to be a runaway gap, the beginnings of the intermediate decline. As soon as we started to bounce back up, though, we lost that and became a higher probability. The probabilities increased that it would be just a common gap, which means we fill in sooner rather than later, and we did, just like we did over here on June 30th, which again had a lot of characteristics of an exhaustion gap, and we filled that one in here. So we did get a higher high, we did get a higher low, though we did close below yesterday's high point. So, and that was all pretty much here at the end as we really fell down with an increase in volume. And that low point is just going to keep moving up because we're not going to test it any time, any day. It's going to take at least a few days. And as long as that high point stays away, then you can see after breaking down once and then really quickly a second time, that usually coincides with a spike to 100 on the negative indicator, which means a new 4-week low point. So it appears, especially with the bandwidth as low, or the size of the channel as low as it is, and expected to just get lower, it appears that we're due for a new 4-week low point, which would obviously mean a break below this divergent low point, and for that matter, also below the 30-day moving average and that 23% retracement that we talked about before. Looking at today's volume and trading range, let's actually come over here. You can see the volume ended up being just a little bit above average at 86 million. The range also just slightly above average. That's interesting that it puts, that we still have, we have very, very low averages relative to where they've been. We're below 1% on the ATR, the relative ATR, when we normalize it to the price of the index. It's a very low level. It's really bullish when we can maintain the trend. But as you see, we're missing a lot of good trending. In fact, we're getting more exhaustion indicators than anything. So in that case, it makes it pretty overbought when you get below that low of a level. And you're really not too concerned about the significance of a decline until you get back above the 1.5%, which now would take a much bigger move than any of these others, as you were pretty much already above 1.5% when all these others, and you had just barely dipped your toe below it previously, and you got back up above it there. So that's when you start, and when you get above the 1.5% mark is when it really gets real. You can see during that bullishness it never did until back over here. Then it finally did, and it got real at that point. The correction got real. So we need to keep our eyes out. It did the same thing in the fourth quarter 2018. Obviously did the same thing with COVID. So getting back above one, now that we're below 1%, getting back above, as long as we stay below 1.5%, then we're fine. And all these little intermediate pullbacks, like this one here, for an example, just an intermediate pullback, and it never did get back up above the 1.5% mark. So we were fine in that case. Even here at the end of the year, we were fine until things did get real at the end of with 2022. All right, volatility, the VIX. Let's take a look at the VIX here, and you can see we did finish the day back below 15. Having made its way below 15 for the first time in a few weeks, pre-expiration, about a week before expiration. But as I mentioned in my technical analysis class today, what was interesting is how big the decline was on the VIX on an absolute basis and on a relative basis, getting back to the 85% mark after having gotten above it. Now it acts as support. So getting back to the 85% mark, getting back down on the absolute basis below 15, but the VVIX here, this purple line, didn't come down hardly at all, and it's still at pretty elevated levels in the mid 90s. So which suggests, as I've been mentioning before, with the ATR of the VIX as low as it is, the normalized ATR of the VIX as low as it is, again, it suggests that we're still due for this compressed VIX to unravel. And it doesn't unravel to the downside. It only unravels to the downside when you've really spiked up. And obviously we haven't really spiked up. So the only way it unravels is with a big move up to the upside. And I still expect that to be the case here. Again, probably sooner rather than later. I wouldn't expect to wait until the fourth quarter of this year to get that. I think we're due that within the month, if not in the month of August, which now starts to traditionally be an elevated time. Remember, that's the seasonal trend for volatility. Is by the end of the month, which is pretty much the day that I leave for our 25th anniversary cruise here. that starts the period, the seasonal period of volatility, which ramps us all the way back up to near the highs of the year, which would have a long ways to go if that's going to be the case, considering the highs of the year at the beginning of the year here was in the mid 20s. So that would be a pretty much 100% gain in volatility. And we talked about the rate of change for the VIX being as low as it got here during this period since the regional financial issues. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Pretty much 14-week rate of change, so almost a 3-month period. To have as big of a drop as we did in the VIX typically leads to a pretty decent 14-week run on the VIX of potentially up of 100%, which would get us back to these highs, if not further up above. So again, we're in the beginning stages of that. It won't just happen like in one day. It could happen in 1 or 2 weeks, as you can see, or it could end up being like it, over here with COVID, it took 1, 2, 3, 4 weeks. But generally speaking, it takes one options expiration cycle. That's when you tend to get the big move, the big spikes. It can go over a couple as it did in 2021. But you can see really you get the big spikes. It's generally over one options expiration cycle. You had 2 out of 3 there in 2018. You had 1 at the beginning of 2018. You had 1 in 2015, 2 at the very end of 15, 1 here in 2011, which was the credit crisis. You get the idea, right? Here's one. This would be in 2014 with the Brexit and the Ebola scare and the ending of QE3. Here's 2010, which prompted QE2 to come out. And then, of course, even in 2008, the biggest move in the VIX early on was this July 2007 period that where we really kind of hit the fan and broke out up above 20 and stayed there. But then in August and September and October of 2008, pretty much 2 expirations. So it's 1 to maybe 2 expiration cycles where we get the big move, but you can start it with an expiration cycle that's relatively small, right? Relatively small, like all these kind of big ones kind of start off with a little move off the lows, just a little move off the lows before, and this one's a little bit bigger, but a little move off the lows before you get the big spike. So let's see if we don't end up getting a little move off the lows here, because it was such a large move. This 3 period expiration drop, the VIX over the 3 months here, 1, 2, 3, again getting down to whatever that was, 47%. That's a pretty low number, and again cycles back up to the upside there. All right, now let's take a look at what's driving a lot of this price action here this week, and you can see the trend continues to be strong here for the Qs over the past 3 months, this rolling 3-month window. But let's just remind everybody, when we go back all the way to when the whole correction started here up until now, by the end of the year, the Qs were the worst performing asset class in 2022, down 35% roughly in that area from the peak of the market, not for year to date, but from the peak of the market there. So the Qs had been the biggest decliner pretty much all year long, pretty much matching real estate as well as long-term bonds, TLT, and its declines there to the October lows, November lows, and then they had recovered a little bit by the end of the year. So for the Qs to do as well as they've done this year, pretty much has put it now, like you can see how developed markets did really well at the end of last year. The S&P did really well. Like they were kind of matching, the developed markets was kind of matching the Qs all the way until about October. Then the EFA took off and the Qs didn't. And the S&P kind of started to rebound. And even IWM, which was kind of mirroring the S&P, it started to rebound. But the Qs didn't until the beginning of the year, and that's when it made up ground and is now caught up significantly. And you see that, of course, in this ratio chart. When you look at the ratio chart of the Qs relative to IWM here we go. It was at the beginning of the year that it started to ramp up. It really started to ramp up with the regional banking crisis. So there in March, right here is when it really started to ramp up. So IWM fell and the Qs took off. But the Qs was rallying already in January. And then now pretty much it's caught up to where EFA is and where SPY is, up there, up at the top end of things. Whereas IWM and EEM are still both down about 20% off of that early January peak. Long-term bonds down 31% still, near its lows. And real estate REITs, at least, still struggling. Even though real estate companies are doing really well and housing is doing okay or very strong, the REITs are doing very poor. Of course, they struggle in a rising interest rate environment, so they'll tend to match what TLT is doing there. On the other end of the spectrum, the dollar remains very strong. It's had its pullback, but again, off of that January peak of the S&P, the dollar's been very strong. It's been outpacing all equity asset classes and is kind of matching what's going on with commodities, even though commodities are well off their peak, and gold, which is kind of off of its recent highs, which were kind of matching those original peaks when inflation really became the big buzzword there at the beginning of this whole mess. So you can kind of get an idea, like there's a reason why the Qs have done so well this year to date. It's not because anybody saw this magic ball that the Qs would be such a big outperformer or AI. It was because it was so oversold. And now it's not so oversold. It's matching where everything else was. It's caught up. And in fact, it's actually reversed its move against the, again, IWM was an outperformer until the regional banking issues. And then now the Qs are the outperformer and IWM is the laggard. And that's, like I said, showing up here, though you can see that it's starting to, come down here below its 8-day moving average after hitting its highest level of this entire cycle here. You can see the MACD has been converging and rolling over. The long-term MACD is at very, very strong levels. Everything else looking like it's not nearly as bullish. Like we definitely are in convergence mode, and you're close to turning this ship around. Again, when this falters and fills in that gap, that's generally not bullish. The only time in recent history that it was strongly bullish for the markets to have this ratio really drop was during the reopening trade, when we had the vaccine and we started to reopen things, and that impacted the Main Street companies more, like the Russell 2000, and they benefited from that reopen, and they really outperformed during an overall bullish market. That's not normal. That's the abnormal, right? That's the abnormality. That's the exception. The rule is when this declines, like it did here for most of 2022, then that's bearish. That's a reflection of risk off moves. And again, you've seen a little bit of that in the ratio of discretionary to staples. You can see just again how bearish that ratio was during most of 2022. Really started with Thanksgiving, started to break down. Again, we've had a very high level of momentum, similar to some of these other peaks, and all these levels of momentum led to moves to the downside. And so you can see where the CCI is, the RSI, the positive indicators back below the negative of the ADX. We had such a big strong peak in the RSI, excuse me, this is CCI down here, such a strong peak in the RSI that again, with a little bit of a divergent high point here too, you would expect that it's not going to be too long, especially considering 2.3 appears to be kind of a level of resistance here, multiple touches across this time frame. It won't be too long if this ratio kind of hits its peak and rolls over. Another risk ratio here is looking at copper relative to gold. We've done that a few times. This has already declined, so you can see again it fell, especially there in a good chunk of 2022. Started to rebound late, reflecting a broader risk on move, but you can see it's been really bearish. So again, we've been a lot more bullish than even this ratio would suggest. This ratio would suggest from an industrial standpoint, maybe we're not nearly as bullish as we think we are. The industrial stocks had a good run here during that rally, but you can see we're already starting to converge on that and consolidate that move to what would be a lower high point. You would expect to move down to a lower low. So not a whole lot of risk on patterns here. Remember, breadth was a big issue. We got back to being positive on the breadth, though we are still below the moving average. So keep that in mind there. The breadth for the number of stocks above the 50 and 200-day moving averages both have formed lower highs, though still above their moving averages too, still above 300. Getting below those moving averages tells a different story. The skew after right around the July 4th holiday, getting up to 150, jumped back up to 148. So the skew continues to tell this picture of significant concern for fat tail risk, like not just a pullback, but a correction, right? This is looking at more of a correction. Pullbacks, when I zoom out on the skew here, you can see pullbacks, the skew gets up to around 130s. And of course, you can see some of these corrections. 2018, it got up to 150. 2015 and 16, it got up pretty high. And 2021, it got really high. It priced in the correction 6 months before it started. But again, here we are again pricing in what would be another correction, though this one would be coming down from a lower high point rather than a higher high. And again, would suggest, and again, it doesn't mean we'll get one. It just means that the option market is pricing in one, that the fat tail risk is there because this is so high. Even the 20-day average of its higher, the only time it's been higher is pricing in that correction that everybody thinks was a bear market. It was that significant, that bad. The only reason why it wasn't is because we were so far above the 200-week moving average that getting down to this low basically got you to the 200-week moving average, and that is the definition of a correction, breaking below the 50-week and filling in the gap down to the 200-week, which is what we did here. Breaking below the 200-week and staying is what a bear market is. Let's look at the sector moves. So let's come over here to the sector rotation and take a look at how things performed here today. You can see again the big three are still big winners on a 3-month basis, but if you look at, here, let's zoom out so we can see a little bit more. You can see the big winner today was energy materials, again dollar related, but energy materials are your biggest winners. Staples, utilities and healthcare, and real estate for that matter were your biggest losers. So again, they benefited from the risk on move early, which is dominated by energy materials, not your typical risk on sectors, but you can see technology and communication services ended up the day underperforming the broader market. If I zoom out to the full week, remember it was a holiday week, so half day trading and then a day off, so pretty much 3.5 days of trading. You can see here healthcare was your biggest loser, has been a big loser here. Real estate, utilities were your big winners on the week. They had been the big winners going in. Communication services ramped up thanks to some Meta, Google moves. But utilities and real estate still holding up there. Amazon benefiting too and helping discretionary stay strong. And you can see everything else. Cyclical areas really underperforming the broader market. Even staples underperforming there, really coming down after having some wins against discretionary early. Today really lagging behind. Remember, we look at this 12 grid to see if and when we start to get any kind of pink shading or red lines. So we got dark green and green lines across the board on the top row. We have dark green shading and green line all across the board on the middle row. So good signs there. And then you can see the weakness in utilities and staples and healthcare. Healthcare about to turn dark pink shading and a red line. You have to get below 50 dark pink shading. But you get the idea that we're starting to see some weakness over here in these safety trades, in particular these interest rate sensitive areas, because that's been such a big mover here. The interest rate sensitive, the 10-year yield really, like, it dropped initially on the jobs report, but then rallied back up above 4.05%. So we're still staying at 4%. I mean, this is one of the biggest weeks that we've had. Here we go. One of the biggest weeks we've had in yields in a while. Right, the big move higher. In fact, the last time we had that was during the run in 2022 up to the mid-October lows on the market and the mid-October peak in yields, where we've made the first foray above 4%. And it appears that we're doing that again. When you look at the rate of change and go to a weekly chart here, and then just change it to the one period, and then go TNX here. Again, you can see just how strong of a move this was this week. Like the last time we had this big of a week was coming off of that low. This case, we're not coming off a low, we're actually breaking through a previous high point. So something to keep an eye. In fact, really when you look at the last 1, 2, 3, 4, 5, 6, 7, 8 weeks here, yields have had a pretty decent run. 8 periods. Up about 17%. So, more of a run that we've seen since last year, when it had some really significant runs that put a lot of pressure on equities because, again, cost of money getting higher. All right, now let's take a look at our trade idea of the day. I want to take a look at ADSK. If you see that it's been in the sideways action. This is actually a trade that we've had on. We've had an iron condor on for the July expiration in our class portfolio. As you can see, it's been a sideways trend for most of this year, this past 12 months at least. When you look, again, its market forecast is weakly bearish. So the intermediate line is in bearish territory, so this is an intermediate pullback, but there's hardly any like dark pink shading and a red line forming here. So it's about as weak of a bearish move as you can get. You're already getting a little bit of a bullish divergence on the near-term line that suggests it may be ending. When you look at the weekly chart for ADSK, it's very sideways. You're getting lots of arrows. You get not very much of a move, very small candles. The PPO, the moving averages are pretty much right on top of each other. When you look at the 3 green arrow chart, spread out those lines there. You can see the lines are pretty much all. In fact, we almost hit every one of them with today's range, and we definitely have in this past week's range. If you look at the weekly chart here, or the at least going back to last Friday, we've hit all of these lines within the range of the week. So they're all sitting right on top of each other right now. A little bearishness because we are below the 8, and the 8 and 17 are crossing below the 30, so there's a slight bearish bias. But you notice it's pretty much one big volume node because of how sideways we've been, and we're sitting right on it, a little bit above it, but right there inside the value area for the past year. All these indicators here showing sideways patterns. The DMI has both lines below 25. The RSI and the CCI have both lines here in the middle. Again, slight bearish bias, but still in the middle there. And then looking at like the Ichimoku cloud, there hasn't been a trend. We had a little bit of a bullish bounce. It came right back down. We're trendless right now. We're below 1. We're below 50. So there's not even a weak trend going on. And of course the Bollinger Bands and the Keltner channels. You can see the bands are kind of fluctuating in and out of the Keltner channel, but not very much momentum. Lots of red dots. And the bandwidth falling again from from a not a very high peak and falling back to a convergence mode. So same setup as we had before. When you look at so like I said, we have a July condor already for expiration, but this is the trade that we did here today before the market closed in the Market Outlook live video I talked to you about earlier. We sold the 20 deltas, buy a strike away. Sold the 20 delta here. It's a $10 wide spread on top, so I had to go 2 contracts on the put side to keep it even. But there's our risk. We ended up getting about $310, and our risk is less than $600 or about less than $700. So we're getting a normal reward for less than the $1,000 that we typically use to get it. So I like that, and those break evens you see are right here. So outside of the bands. And not only outside of the bands, but again, most of this year's range has fit inside of, ADSK. Most of this year's range has fit inside of, brief moves in and out of this break even. So as long as we stay around that point of control, then that's kind of the point of the trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's comments, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like our video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.